The Eurodollar futures curve has inverted. That is bad news for the global economy and all of us. In part one of this episode, we already talked about what happened in 2018, as well as more of a background ABC 101 elementary kind of background information, first principles on what the Eurodollar futures curve tells us. So check that out if you missed it. Right now in part two, we're going to go back and review another episode when it happened in December 2006. Then another maybe different, but maybe similar, one in July 2020. And then the rest of the show, we're going to focus on what just happened. December 1st, 2021, the Eurodollar futures curve inverted. What does it mean? Jeff, let's go back and, oh, by the way, ladies and gentlemen, the article you want to be reading along with us is, this is a big one. No, it's not clickbait. December 1st, 2021, posted at the Alhambra Investments blog by the head of global research for Alhambra Investments, Jeff Snider. Jeff, December 2006, the Eurodollar futures curve inverts. Wow.
Big stuff, right? I doubt anybody remembers because you certainly didn't make any of the news or the financial media. And if you read some of the private transcripts from FOMC meetings we had, I think we talked about this before, maybe not. I've certainly written about it many times before. Bill Dudley, the head of open market operations, who said, who cares? Eurodollar futures, we don't care about Eurodollar futures. Obviously, we're not going to cut rates anytime soon, so the market must be completely wrong. But yeah, Eurodollar futures, important part of the marketplace, inverted curve, as we talked about in the previous segment. Curves are supposed to be upward sloping, especially in a period when, especially like 2006, Alan Greenspan and then Ben Bernanke's rate hikes, things were supposed to be good and inflationary. Why wasn't the curve upward sloping? And more than that, why did it invert in December of 2006? What was really going on at that time? As much as everybody was told to dismiss these problems, remember subprime was contained, here we had a very, 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 very early warning that this wasn't, not only was subprime not contained, this wasn't really about subprime. There was more going on here than simply just a bunch of bad mortgages.
Jeff, we haven't mentioned it. We're just assuming people know, but this isn't just some out of the way market, Eurodollar futures. This is one of the biggest markets in the world, one of the most sophisticated. So it's not like we're talking about the Myanmar stock exchange and like, well, whatever. No, this is a highly complex system and everyone's coming here and spending billions of dollars to try to get it right. So maybe that's a good indication we should pay attention to.
Just say the notional contract, the notional amounts, and these are fictional Eurodollar deposit accounts, the amount for each major quarterly contract, the numbers are into the trillion. So this is not a small market. In fact, next to the US Treasury market, it's probably the largest, most sophisticated, deepest market in the world. And as you pointed out in the previous segment, it's about 3-month LIBOR. The name is Eurodollar. This is the market that is actually focused on the Eurodollar system itself. So it's not just, as you said, it's not just some niche market out of the way that we should ignore. It is basically the one tool we have that looks at the very thing we want to know about from the perspective of those operating in the Eurodollar system, telling us what they think is going on or what they think is going to be able to go on in the near future, and then pricing it for us, giving us all sorts of useful information about what is happening and what we should expect to happen over time. It's incredibly important.
Well, it's incredibly important if you're interested in money supply and demand, not narrative, Jeff. So we know where that comes from. July 2020 now. We've discussed June 2018, December 2006. I think those are similar to what happened is happening right now, December 2021. Is the episode of July 2020 similar or different? And it shouldn't be included in our group here.
It's categorically different, but that doesn't mean it's something we should ignore either. It wasn't the same sort of inversion. It was sort of an inverted inversion. I think we talked about it back then, which was simply just a different kind of market skepticism about the Federal Reserve's digital flood of money, which the market keeps preparing for at each and every year end. That, there's a chance that we could have a monetary issue which would lead to LIBOR rates skyrocketing, which is why you had this little tick or pucker in the Eurodollar futures curve around the early next year contracts, especially the more liquid quarterly ones, which was just the market saying, look, Flood of money? No, there's really not a flood of money, and we're really concerned about year-end periods.
We're going to look at 3 charts in a row now. The first one, Jeff, we're going to start out looking at a chart that shows 5 different lines representing 5 different days between August 2020 and August 2021. And I see generally an improvement from our first line to our second line, but then ever since then, kind of a retracement, unreflation. Can you tell us what these lines mean? Do you have it in front of you, or do you want me to read it out to you?
No, I got it. Look, it's again, it's very similar to what we just talked about in the early 2017, 2018 period, globally synchronized growth. You have the reds and the whites, which are the front contracts reflecting what they think, what the market thinks is going to happen in terms of immediate Federal Reserve policy and other factors that might influence 3-month LIBOR, which mostly the Federal Reserve policy because of the return alternatives to money markets and deposit accounts and things like that in the Eurodollar system. So you have the steepening of the yield curve, especially at the front end, but also in the back end too, which is consistent with reflation and more optimism. Remember, upward sloping is beautiful. Upward sloping is healthy. Upward sloping is good. So from August of last year until about March of this year, consistent with the yield curve and other financial indications, the market was becoming a bit more optimistic about the future, which, I mean, coming off of a very bad recession in 2020, that seems to be natural, even if even if the rebound from the low point wasn't really all that much to begin with. The market was at least saying, we expect the rebound, whatever it is, whatever shape it is, to continue into the foreseeable future. But that only lasts, as you said, that only lasted until about March. In Eurodollar futures, I think it was early April when the curve finally peaked. And then from then, you got a little bit more skepticism. The curve was still upward sloping, but prices started to go up in Eurodollar futures pricing, which meant lower interest rates overall predicted in the future, which is sort of a negative indication. This was coincident to the flattening in the yield curve, which was, again, another deflationary pressure, another deflationary potential indication. So we have this, okay, we had basically unfettered reflation until March. And then since March and April, it's been more questionable in both the yield curve, Eurodollar futures, as we pointed out before, swap spreads, the rising US dollar exchange value. All of these things together are saying the market's starting to get incoming information that isn't so rosy, it isn't so good, and maybe this unfettered reflation, this other, rebound from 2020, maybe there's darkening skies ahead. There's problems that are starting to crop up that we should start paying more attention to.
From the end of March, thereabouts, roughly speaking, early April, as you've got on here, to early August, that coincides with the US Treasury yield curve, not yield curve, but the US 10-year US Treasury yield going in the wrong direction, saying, yeah, I'm not really liking what I'm seeing out here when it comes to economic recovery and hope. And that's what we're seeing in the Eurodollar futures. We're seeing it represented there as well. Then, as we talked about before in previous episodes, from the very early part of August through, somewhat recently, we've had a recharge in the reflation talk of taper, talk of hiking rates, talk of accelerating taper. The delta's being pulled back and things might be getting better. We're reopening again. And that's what we see in this second set of graphs, of Eurodollar future graphs. We start out with our August, where we left off on the previous graph. And then we go to October and November. And it seems like it's rising. Positive. Good news.
Yes, but it's rising in the same way the curve rose in early 2018. It's rising in the wrong way, right? Because you're right, especially since August and into September and October, we had more taper. And then, of course, the announcement for taper. Now we've got hawkish policy, talking about rate hikes being accelerated, all that stuff, which is reflected in the Eurodollar futures curve in the whites and the reds, the front part of the curve, which got much steeper, as it normally does, as it did in the early part of 2018. But coincident and consistent with all these other negative indications, you get into the greens and the blues of the Eurodollar futures curve. All of a sudden, it's not steep there. It's starting to flatten out, not just flatten out a little bit. Also, like 2018, it flattened out a hell of a lot. So the market was saying, yeah, the Fed's going to be hawkish in the short run. We see that in the whites and the reds. The front part of the curve steepens. But we think the Fed is hawkish for the wrong reasons, like 2018, because the Fed really doesn't know what's going on in the economy and the monetary system. In the market, the Eurodollar futures market, like the Treasury market or the German bonds or JGBs or any number of other markets, interest rate swaps, they're all starting to see negative signs, negative signals, negative indications pile up that gets reflected in a flattening Eurodollar futures curve, particularly in the greens and blues in this instance, which is, again, it seems like there's two different curves being traded at the same time, which is that's really the case. And it's very reminiscent of 2018. And in fact, it's almost a perfect carbon copy of what happened in the middle of 2018.
In that list of other market indications, you forgot to mention the US dollar, which is also rising, just like 2018. Okay, so now we move on to our final graph for this episode. Yes, our final graph. Now we're just focusing on the most recent weeks, late November. We start out with the last point from our previous graph, November 22nd, and then 26th, the 30th, and the 1st. And that's where we see the inversion. We see it flattening, and then inversion.
Yeah, and it's really since late October. And again, it's consistent across all of these marketplaces. You look at October 21st, I believe it is, that was the most recent top in the 10-year Treasury. 10-year Treasuries, like the 30-year Treasuries, longer-term Treasury yields have been falling since October 21st, which is a reflection of these same problems, the same deflationary potential the market sees from inside the system. And coincidentally, not random coincidence, but just timing-wise, the Eurodollar futures curve flattened and flattened more going back to October 21st. And then over the last couple weeks of November, this flattening really took shape. I mean, obvious shape, the last half of November, before we heard about the latest strain of COVID, before anything, all this deflationary potential that's been building up since March. We're talking about 8 months here. Now we start to see the Eurodollar futures curve almost perfectly flat. And some days it was perfectly flat in the greens where the greens meet the blues. So, the middle part of the Eurodollar futures curve, but it never inverted. It didn't quite invert because, inversion really takes a lot to invert. And that's flat curve is already concerning, but the fact that it didn't invert was sort of okay, the market's, really trying to take a very solid look at what's going on, what it perceives and what it sees, but it's not yet ready to commit to, like it did in 2018, sort of the going past the point of no return. But that happened on December 1st. On December 1st, for the first time in this cycle, this part of the Eurodollar futures curve did invert. And it not only inverted yesterday, because we're taping this on December 2nd, it's also inverted a little bit more today. So it's sticking around.
Bitch.
It's one of those things where, okay, the fact that it inverted, we're already paying attention. Our radar is already up and looking at this. And the fact that it's sticking around is one of those things, because that's the next part. Yeah, inverted, but is it just a short-term fluctuation and maybe some technical problem somewhere that's really explains it? We don't think so, because the way it's been flattening out over a significant chunk of time, it's almost like we expected this to happen, but still, we want to see if it continues and if it grows, because if it does, like 2018, this is a tremendously powerful signal that the market has perceived a set of factors that are deeply negative, they're deeply deflationary, at least anti-inflationary, that something has substantially changed such that this curve, which should be upward sloping, but has been flat, is now no longer flat. It's actually a tiny bit inverted, which is, again, this is a big one.
Jeff, I don't have anything more. I thought maybe mentioning that, you earlier mentioned something about the coronavirus variant and how you had written in a previous blog post that doesn't really matter what it is, what snowflake, what feather, what cherry on top. The conditions were being set. Who knows what it's going to be? It's the conditions that we are observing. And so is the coronavirus XQ, whatever it is, whatever version we're on. But it just could be anything. I thought about mentioning that, but I decided I'm not going to. So is there
I
anything?
think that's a really good point. What we're talking about here, whether it's the yield curve or the Eurodollar futures curve or anything else, is probabilities, right? We can't predict the future. We don't know what's going to happen. And so we look at the yield curve flattening out since March, and here we are with Omicron. Did the bond market predict Omicron? Well, no. What the bond market did, like in the bond market, including the yield curve as well as Eurodollar futures curves have done, have said, look, we'll take a very comprehensive, broad view of the monetary system, economic climate, and say, what are the balance of risks? Now, when the curves were steepening, especially in January and February of this year, what they were saying is that the balance of risks have changed favorably. Maybe we will get a recovery this time. Maybe there will be a tiny bit of growth in inflation. And so the curve steepened out, not just in the front ends, but across the entire curve. And that was just balance of probabilities had grown more favorable. Now they've been grown more favorable than 2020, which is an incredibly low standard, which allowed the media to run wild with these stories about inflation, when really it was just a tiny little bit less pessimistic than it had been previous. But since March of this year, March 2021, these curves have become more and more pessimistic. And what they're really telling you is that in very non-specific terms, the balance of probabilities have shifted. They're tilting more and more toward the downside. There's more downside risk than certainly being talked about or appreciated in the mainstream narrative. And this downside risk has grown over time, not shrunk, despite the fact that we have these enormous CPIs that make it seem like we're in the 1970s again. The market continues to be more and more resolute. The downside risk, deflationary risk, are far more likely than any continuous upside inflationary risk. And what that really says is we don't know what it will be that eventually tips everything over into more of a deflationary condition like 2018. We're just increasingly confident that this is going to happen, that something is going to come along. We don't know what it is, but something is going to come along and it's going to push the system out of this, upward rebound, lackluster recovery and into the same kind of familiar downturn we've seen time and time again. So whatever it is, and the longer this goes, the more the market is saying, not only do we not know what the specific spark will be, it won't even take a big spark to change everything and move it into the wrong direction, to change an upturn into a downturn again, like had happened in 2018. So it's not like the markets have been predicting the next variant of Omicron, or the next variant of COVID. What they've done is say balance of risks means that something small could come along and it could turn out to be very big because conditions are ripe. They're deflationary. We have all of these problems that nobody in the mainstream seems to be writing, reporting, talking about, that are very real. We may not be able to see them because they're in the shadow system, but we're going to trade on them. And here's the information. We're telling you based on these curves, what we think from the inside, the probability distribution of the intermediate and near-term future are going to be. And when you see one of those curves tip into inversion like Eurodollar futures, that's the market really telling you very strongly that the inside perceptions of probabilities moving forward are tilted very heavily toward the deflationary side.
In part 3 of this episode, we're going to go back to episode 168 and revisit an argument we had whether or not quantitative easing affects bond yields. In that episode, we discussed whether or not the flow, the purchases, affect bond yields. This time we're going to talk about stock. Does it matter how much of a certain asset that you've got on your balance sheet? Will that trigger an impact in bond yields? So you're just not going to want to miss it.